Setting clear goals and time horizon. Before you start investing, one of the most important steps is to set clear goals and define your time horizon. In other words, understand why you're investing and when you'll need the money. These two factors form the foundation of your investment strategy. 1. Why your goals matter. Investing without a clear purpose is like taking a road trip without knowing the destination. Your goals give your investments direction and help you make better choices. Ask yourself, am I saving for a short-term goal like a vacation or a home down payment? A medium-term goal such as college tuition or a business? Or a long-term goal like retirement? Each goal comes with its own timeline and level of acceptable risk. For example, Sarah, age 30, wants to buy a house in 3 years. She should focus on preserving her savings and avoiding risky investments. Marcus, age 35, is saving for retirement in 30 years. He can take more risk and focus on long-term growth. 2. Understanding the time horizon. Your time horizon, how long you'll invest before you need the money, determines how much risk you can afford to take. Generally, the longer the time horizon, the more risk and potential growth you can handle. Short-term goals, 0 to 5 years. If you'll need the money soon, your focus should be on safety and liquidity, keeping your funds safe and easy to access. Good options include high-yield savings accounts, certificates of deposit, CDs, short-term government or corporate bonds. These don't earn huge returns, but they protect your money from market volatility. Medium-term goals, 5 to 10 years. For goals in this range, like saving for a child's education, you can afford some risk but still need stability. A balanced portfolio works best here, mixing stocks and bonds such as a 60-40 split. This allows for moderate growth while cushioning against market drops. Long-term goals, 10 plus years. If your goal is decades away, like retirement, time is on your side. You can focus on growth-oriented investments such as stocks, index funds, or ETFs. Over time, the power of compounding, earning returns on your previous returns, can significantly multiply your wealth. For example, $10,000 invested at 7% annually becomes nearly $40,000 in 20 years and over $75,000 in 30 years. That's the power of patience and compounding. 3. Risk tolerance and adjusting over time. While time horizon determines how much risk you can take, your risk tolerance, how comfortable you feel with risk, also matters. Some people panic when markets dip. Others stay calm. Choose a mix of investments that fits both your timeline and your comfort level. As your life changes, your goals and time horizon will change too. That's why it's smart to review your plan annually. When you're younger, you might invest mostly in stocks. As you near retirement, you might shift toward bonds and cash to protect your savings. This process is called rebalancing, adjusting your portfolio to stay aligned with your goals and timeline. 4. Balancing multiple goals. Most people juggle more than one goal at once. For example, building an emergency fund, saving for a home, and investing for retirement. One useful method is the bucket strategy. The short-term bucket holds safe, liquid assets for near-term needs. The medium-term bucket mixes growth and safety. The long-term bucket focuses on high-growth investments for the future. This approach keeps your money organized and helps prevent dipping into long-term funds for short-term expenses. 5. Key takeaways. To build a strong investment plan, define your why. Know your goals before choosing investments. Set your timeline. Match risk to how long you have. Diversify. Spread investments to balance risk and reward. Stay flexible. Review and adjust as your life changes. By setting clear goals and understanding your time horizon, you make your investments purposeful, disciplined, and aligned with your future. Investing isn't about guessing the market. It's about having a plan, giving it time, and letting your money grow with patience and clarity.